I was briefly introducing myself. My name is Gonçalo Moreira. I've been working for FX Street since 2008. Nowadays covering advisory tasks. I'm also the co-author of the Learning Center. I like to say I'm the co-author since Maud, our communication manager, has been extremely helpful for me in developing the project. And also co-author because the Learning Center is made of many quotes, many sources from our experts, from our collaborators. And so in an indirect way, I'm not the solely author of the Learning Center, but it is a compendium of sources and knowledges. Fine. To the current session, this will be the trading plan series. It will be called. It's a series of webinars dedicated to the trading plan. This is the first of them. We will talk about the inventory. What's the inventory? You may ask. Since you see, maybe we shall start with a brief introduction on a trading plan, since there is a wide array of definitions of what a trading plan is, and these definitions stem from very simple ones, from being a post-it on your screen to a full-fledged document with all kinds of indications on metrics, on routines and procedures. So the different definitions you find on what a trading plan is more or less a semantic issue, because every trader would agree that components like a trading journal, or the fact of the importance of monitoring our trades, the importance of testing our strategies. All these belongs to our work as a trader, and the definition that we have carried on during the Learning Center is of a trading plan that is made of all these elements, and the inventory is one of these components. So we are going to see an example of an inventory. I will take my personal inventory to this webinar, so that you can see with a real example what an inventory is. By the end of this section, there will be an interactive quiz based on a e-learning tool that we use at the Learning Center. And at the end, very briefly, links and references will be provided, and also a moment for questions and answers. So, what definition of a trading plan? More or less, this is what we have told right now. This is a compendium of several components that may be may range from a checklist, from a watch list, from a trading journal, a trade log. All these are components that belong to a trade plan. So if anyone has an idea of a trading plan being a list that you check on a daily basis, that is valid only for the current trading session. So this would be more like what we understand of a watch list or a decision matrix, where the rules are that you are going to use for that trading session. But there are other elements in the trading plan that you may check once in a while. It doesn't mean that a plan, although our idea of a plan is rather complex, it's not complicated, and it's being very, very vast. It's not something that you consult every day. There are many elements of the trading plan that you check just once in a while, once in a quarter, once in a month, But there are other elements of the trading plan that you check every day, like a decision matrix where the rules are set, the rules that you use to trade, or a watch list that you prepare in the beginning of the week. So these are elements that belong to the trading plan and are that you should have by hand on a daily basis. So the importance of a trading plan in itself would be the fact that it gives you a structured approach to your work as a trader. It can serve you as a guide, and also keeps you on the right track. To the point about conceptualizing your methodology, here is where the inventory has its major function. See, everything that we use in trading starts with an idea, starts with an observation, starts with a note something that you hear from someone that you identify with, and then it's once this idea emerges, then you start to conceptualize, to work on these ideas, and you start establishing working hypotheses and to measure them, and only then you can formulate it as a strategy, as a system, as a methodology. But in the beginning, we will stress the importance of starting on a more conceptual level. So just to get into business and get the inventory done, we will go through a listing of statements, of observations, and so on that belong to my trading list. So this is something very personal, but I wanted to share it with you so you have an idea what we mean by inventory, and so that you can see what place would have the inventory in your trading and in the overall plan. So this list will be made of several points. This is the first one where I say I understand that many market participants make wrong decisions. They buy close to resistance and sell close to support. I want to enter the market at these levels where decision errors are most evident. So this is an observation. This may also be something that you learn by experience. You learn by the experience from someone else. An inventory or the elements of your inventory. It's not a question of being original here. So you may adopt many ideas from other traders, from the experience of other people. And if you identify with these ideas, you put it on a list. The list is something you will see. It's something that is not fixed. It's something that you may change over time, and you put everything, all the beliefs and statements and observations that you take note. So, for example, starting with this one, so I may once this is a concept, this is an observation, but this may lead me to develop a strategy later on. Another one would be most participants enter the market once a price movement has already started. That is a reactive approach. How can I be proactive? Being proactive prevents me from acting impulsively. So this is again another observation. We may have observed also in ourselves in the beginning of our trading experience how impulsive we were, and taking into account that many people in the retail sector have little experience. We can deduce that a big part of the actions that take place in market, and that ultimately shape price action are derived from wrong decisions, the wrong decisions that we mentioned in the last point, and being aware of that, I take note in order to build a strategy out of it. Okay. The third point would be price movements toward an equilibrium point seem to be technically more efficient. Equilibrium can be expressed as an average, a pivot point, the center line of a grid, etc. So I may observe on the chart that price returns to those equilibrium levels once in a while, and these equilibrium levels may be, from the technical point of view, be expressed as an average, a pivot point, a center line of a grid. So I may observe this component of price action, of the behavior of price, take note of it, and use it as a concept to later on establish a working hypothesis, or later on a strategy. For instance, I may say, okay, I noticed that a certain currency pair returns to the weekly pivot point. Statistically, I observed that it returns to the weekly pivot point 90% of the weeks. Okay, so I'm already measuring this concept. I started with an observation from my inventory, and I started to measure it. I observed that a certain currency pair, touches the weekly pivot point 90% of the time, for example. So I'm going to measure it, and later on, I'm going to find out what tools do I need to capitalize on this concept. So we are starting with a concept, and we're not starting with the indicator itself. So because many times when talking to aspiring traders, there are questions like, can I make money using the MACD and Bollinger Bands, for example? And the answer here would be, well, I bet you can. I mean, there are many people earning their money with very simple tools and strategies. But the question itself, I don't know if it will lead to a robust methodologies. This is probably the same as asking, may I build a business, a brick and mortar business with a hammer and a handsaw? I mean, I bet you can if you are good at hammering, if you are good using a handsaw. But I mean, there are many things that you should take into account. I mean, the hammer is a cost, the handsaw is another cost. How many times can you use the hammer till you need another one? And all this belongs also to our considerations that would belong to the business plan. In the same sense, this is the same idea that we have of a trading plan. So the importance of starting a strategy on a conceptual level is that you don't start with a tool. You start with a concept, with an idea. You measure that idea, and then you search for the tools, the best tools to capitalize on that. The fourth point would be, I noticed that price follows the path of least resistance. If the price prints several candles in one direction, the lack of intermediate support and resistance levels means there is little resistance. Resistance understood as obstacles. So I may also observe if there is a free rise in price that has a reason, because if we are surpassing an all-time high, for example, and there is a free rise in price, obviously there is no resistance, there is no technical resistance, that there hasn't been any supply before at that price level, so price doesn't find any obstacles and any technical obstacles. So, but this is an extreme example with a free fall or a free rise. It happens all the time. If I notice a recent price move which has no intermediate price levels, I may also reach the conclusion that price when it returns to cross that level again, that those price ranges, that it will behave in a similar way. Okay, so I may adopt also this concept into my trading. Fifth point, intraday price action has a lot to do with market makers' pricing mechanism. I want to enter the market when there is a need for more liquidity. This has to do with the pricing mechanisms of how typical to the spot forex market. And if you research how these pricing mechanisms work, so you can add some conclusions, some new ideas to your inventory, and these ideas may help you in your trading and developing your strategies and so on. So I want to enter the market when there is a need for more liquidity. This has to do, we can see here in these images. The image is taken from an article which is to be found on our education section under Forex Basics. It's called Pricing in the FX Marketplace. I will give you the link at the end of the session. It's from Richard Olson, and you can see here this is an illustration of what would be the market maker in the middle, and buyers and sellers in this case. And this is the ideal situation where the market maker can match the positions from sellers and buyers, because their trading volume is the same, is equal. But things get complicated when there are more buyers and sellers, or more sellers than buyers. This is when price adjustments have to be made. And well, we will go not very deep into this issue right now. It's just for you to have an idea of what we talk when we say pricing mechanisms or liquidity. But the fact is that liquidity is not a constant, and when there are extreme price movements, obviously this liquidity is much less. So you may enter the market when the market is in the need for more liquidity. You will understand this point if you visit this source that I will quote by the end of the session. Number 6 is talks about forex trading is very competitive in nature and is of no service in itself. Providing liquidity at an extreme price level allows me to think about trading in a less competitive way. I'm serving the market by providing liquidity. This is 6 point here is derived from the previous one, but the focus here is less technical, is more personal. As you see in the inventory, we can include also our inclinations, our beliefs of what the trading activity is. And from my point of view, again, this is something very personal that I'm sharing here with you. From my point of view, trading is competitive, and it's really of no service in itself. That means you are making money for yourself or for your company or for your customers, but in the end, it's really the wealth that you are creating, or the activity in itself is not directly of service. You may then, with that accumulated wealth, you may obviously be of service to others, but in itself, it lacks maybe this attribute. So if you are a person that is sensible to that point, you may search for a way to look how can I serve the market in certain ways. So by providing liquidity. Obviously, this is ridiculous from a retail point of view, because the liquidity that you are providing is really insignificant to compared to the liquidity which is usual in the market. But it's just a psychological issue here. So you may find that your relation to the market or your results in trading are affected by the view that you have, the beliefs that you have of the activity in itself, of your beliefs about money, about wealth, and this, from my understanding, should also belong to the inventory, and maybe from such a statement like this one, we could not maybe establish a working hypothesis or a strategy later on, but it can serve us as an input for our goals, for example, to establish our goals, to consider our expectations, for example, and how we want to organize our trading in our lives. So these more psychological issues belong also to the inventory. The next one is a simple one. I noticed that I perform better when I have time to prepare a trade. Such things simply like an observation like that may be useful to include in inventories, because then you may establish a working routine where you dedicate some time to prepare your trades. For example, I'm not saying that everyone should do. This is something that I have observed in myself, in my trading. So I include it to the inventory so that I can shape my trading plan, the other components of my trading plan accordingly. Number 8, I want to find out if I perform better focusing on one currency pair or trading several pairs at the same time. So if you want to find out something, how you perform under certain conditions or with a certain pair, you may include it in inventory, and later on this will serve as an input when you are designing your trading routines. Number 9, technically speaking, I prefer to guide my analysis with confluences of technical levels, moving averages, pivot points, Fibonacci's, round numbers, etc. Confluences are often evident as price levels, which most participants make decisions to buy and sell. Besides, time factor is a key ingredient of a confluence. Okay, this is a technical confluence. We can see it is on this chart. This is a USD Swiss franc daily chart. We see this is it's a downtrending channel that has been tremendously useful for my trading since I don't know how long yet, and it's astonishing how the confluences have worked out here. You see the circles in orange are two confluences on this time frame, which I've pointed out here. You see there is a confluence of the upper border of the downtrending channel, the upper border of the smaller channel, uptrending channel, and also a Fibonacci extension of a previous move. So you have three technical levels confluent at one point. And the importance when I say besides time factor is a key ingredient of a confluence. The good thing of a confluence is that once you have a confluence on your chart and price is not yet there, you have information about the time, about the precise moment when these levels are confluent. And as we see here in this case, it was practically to the day the touching of the confluence and this one has already been quite significant and quite precise in the time. It was a confluence of a major resistance and also the intermediate Fibonacci levels of the downtrending channel. So we understand as a confluence, technically speaking, confluences is an issue that it's quite important, and you should dedicate some time to study it. So it may belong to the inventory of many of you, because it's really something very important. I strongly believe that before considering myself a trader, I am a money manager. So I give utmost importance to research and development of position sizing and position management techniques. This is again you see the definitions when we try to define what a trader is, what trading is, and what a money manager is. By questioning all these definitions, we may find out that we are in fact money managers, and in order to manage money, we trade. So and if you reach this conclusion, you may arrive also to the point to say, okay, if I'm a money manager before being a trader, why am I giving so little importance to position sizing or position management techniques? See, it's just a semantic issue here. We are just questioning the definition of two terms, and immediately we have a hint as to if we are doing things right or not. And so considering ourselves as money managers changes quite a lot, because then you see your capital as something to be managed, and obviously if you are managing it, you want to care about position sizing and position management techniques. By the way, if this is something new for you, if any of these terms in fact is new for you, everything is covered in the Learning Center. So all these terms are to be found there. So we are obviously not entering into the definition of everything, since this is a series about trading plans. So we will dwell on each one of these points. This one precisely is a rather extensive issue. We will probably have more than one webinar dedicated to the position sizing techniques. We are in the Learning Center. I think there is a compendium of more than 15 different techniques of position sizing covered that you may study. So but everything is covered. Let's go to the next point, which says, regardless of the time scale, I share the view that markets are in a training mode only 25 to 30% of the time. So swing or range trading techniques have a higher chance than trade following ones. Okay. Again, this is a personal observation based on a statistical measure, and I may adopt this view, this observation, again to establish and to formulate my strategies. Okay. Number 12, most retail traders and market makers apply intraday techniques. On the other side, long-term position techniques is large institutions territory. The time interval between them, swing and range trading, is the less competitive one. Okay, so types of trading techniques and competitive time frame is the one that is not is starting. I like to compare my analysis with other sources of technical analysis when preparing trades. This is especially useful when you work with confluences. It's a great help to have a few reliable sources to check on a regular basis. FX Street newsfeed is a great resource. Okay, here again, confluences are most easily to find if you compare 2 or 3 good analysts. You chart their analysis, and immediately you will see the confluences, and you can take those levels as key levels for your trading. By the way, the FX Street news feed is really a great resource. You have lots of inputs as to the analysis that are being covered at our site from all of our contributors, and it's a great way, from my point of view, to reach those analyses. You can just by following the feed. 14, my analysis is largely visual, and that is why I need to see my positions on the chart. Okay, if I like to see my positions on the chart because my analysis is largely visual, then I may choose a platform, a trading platform, where I can trade on the chart or from the chart. Okay, so this is something that I will put on the inventory, and then it will help me in the broker selection or the platform selection greatly, because then I will have this in mind. We have a brief question here from Harley. Will you ever be using live charts? Not in this session, because we are covering the inventory. Since we don't need live charts, we are not going to use them today. Okay, but as in future webinars, I believe so. The next one, time frames of 60 minutes and below, are for me difficult to follow because of my work. I've also noticed that if I trade on very short time frames for several consecutive days, then I feel the need to leave the charts for a short time, resulting in an intermittent market monitoring. Okay, again, a personal observation that may be useful. Since only few people trade with a plan, with all its components, the inventory, a watch list, trading journal, etc., and few people are truly winners, I want to do precisely those things that only few people do to gain an edge. Okay, so if I find out that only few people really care about a trading plan, so I may reach a conclusion that I will do a plan in order to do something different. 17, based on these two facts: 1, trading systems are made to generate buy and sell signals. 2nd, many aspiring traders suffer from overtrading. I understand that a trading model should be designed to generate no trade signals by allowing execution only in the absence of no trade signals. What does it mean? Simply, I'm searching for reasons not to trade. Okay, because if you start if you start by developing a strategy, you combine 2, 3, 4, 5 indicators. They will generate signals because they are made for that. So they will generate a lot of signals. But if you start with a concept which you have drawn from your inventory, then you are searching for something to capitalize on, so that signals do not have a prominent place in your trading. It's secondary. So you will design the system in order to prevent you from entering the market. So in the absence of no trade signals, in the absence of when the system is saying there is no reason not to trade, then you might enter the market. So it's really it's the same approach, but you are just turning it around. Okay, so all these things go into the inventory. Personal observations on your personal behavior, on market behavior. You may if you are more inclined to for fundamental analysis, you may take from fundamental sources any kinds of ideas, of beliefs, how you see the activity and so on. All this belongs to the inventory. Fine. Let's go now to the quiz. We have a few minutes left. Just let me here switch the window. All right. 1 second. 1 second, please. Okay. Switch the camera. Second, please. Fine. Okay, camera is on. This is a very short quiz that we are going to do together. You see that these are we have 11 questions. Can you see the question? This one says traders love illiquid markets. If it's true or false. Can you see the question? If you would be so kind and type your answer, then I will choose the answer that most of you will type, so that we can do this exam together. We have here a couple of false. All right, I click the false, and let's submit the question. Okay, the second one says all indicators have been developed to solve a lack, need, or want. Therefore, each technical indicator draws on some original idea. Which idea lays behind the parabolic indicator, often referred as stopping reversal system, the SAR? Let's see, the first one says the indicator assumes that prices close near the low at the end of a rally and near their highs at the end of a downtrend. The second one says prices usually rise at their fastest pace, well ahead of reaching a peak, and usually decline at their greatest speed before they reach an ultimate low. And C, as long as a trade is open, capital is at risk, and unless a trade can continue to generate profits over time, it should be liquidated. A, B, or C? We have here one C from Team. Okay. Anyone? An A, B, D, D. Okay, 2 B's wins. Okay, let us select D. All right, submit answer. May the rate of change indicator, okay, the ROC, be calculated by the subtractor method, that is by subtracting the current price from a price n periods ago rather than dividing it? Yes or no? The rate of change. If you know the nature of the indicator, Can it be used by the subtraction method or only by division? Hard questions. These questions, by the way, they are on the practice chapters of the Learning Center. Okay, this is a yes. Let's type it here a yes. And there are a lot of questions. We have a pool of over 1,000 questions, and the good thing is that many of these questions, as you'll see by the end, have additional explanations where you can draw to your inventory and to your trading. Which factors are decisive when adopting a trading model? A. Evidence from other traders that the model is profitable. B. It should suit your time window, that is, your availability to execute its trading signals in reasonable hours. C. Your trading capital should allow its execution in terms of risk control and money management. Or D. It should be a trend following model. In this question, multiple correct answers are possible. So, which ones do you say? I would say this one. It should suit your time window, right? You say A, B, C, and B. Your trading capital should allow. Okay, it should be a trend following model. How many vote for D? Not many, so we choose B and C. Let's proceed. Okay, please select the chart where the changeover in the demand-supply balance has been gradual. The first, the second, or third picture. In which one has the changeover in the demand and supply balance has been gradual? And the third one. So let's select it. Fine. Next one. What is a signal in the trading system? What is understood by a signal? Signals are buy and sell commands mostly generated by combinations of technical indicators. Signals are buy and sell commands mostly generated by a single technical indicator. Signals are buy and sell commands mostly derived from the trader's intuition. These signals are buy and sell commands when technical indicators contradict one another. A, B. Fine. Fernando, I think you are right. Okay, number 7. If any theory in technical analysis and its buy and sell signals were purely mechanistic instead of requiring experienced judgment, what do you think would happen? It would lose its forecasting value. It would be of greater use than a theory where judgment comes into play. Here we can also use one answer. Anyone? A, fine. All right. Let's submit. Number 8. Are technical indicators capable of accurately appraise the infinity of data affecting the markets? Events, mass moods, individual realities in the form of necessities, hopes, fears, and estimates? Yes, technical indicators process this information in order to generate buy and sell signals. A reading of the supply and demand for a certain currency, which is ultimately what moves the exchange rate? Or no, technical indicators are a mechanism designed to reduce and process the available information given in a chart. B, very well. There is a consensus this time. Number 9, what is the concept behind the idea that all price action is the addiction of all active cycles? This is more classical theory, technical analysis. Says A, proportionality, B, synchronicity, C, amplitude, and D, summation. I would say the answer is in the question. If we say Addition? D, right. All right. Number 10. The chart below pictures the EURUSD daily chart where an expanding formation is drawn. On the bottom, a plotted momentum indicator has two trend lines on it. Taking into account the momentum's characteristics, which of the lines would be signaling the most reliable entry? That is, a break of this upper line or a break of this, the B line. This is the B and this is the A. Which line break, taking into account that we have here an expanding formation and a first down leg, which of these breakouts would be the most reliable signal in this case? Donnie says A. Take into account, if we take A, this means the price is breaking here to the upside. B, 3A against 2B. I vote for B. 3B for, okay. With my vote, B wins. Let's see. Number 11. Last question. In a discretionary trading approach, which of the following definitions of trading systems is not true? A trading system is a set of rules that formulates buy and sell signals without any ambiguity or any subjective element. B, a trading system is a resource for making trading decisions. C, a trading system is an analytical tool and is not used to get buy and sell signals. Which is not true. B. A trading system is a resource for making trading decisions. A trading system is a set of rules that formulates buy and sell signals without any ambiguity or any subjective element. Let's choose it. All right. Okay, the exam is being processed. Sorry, we have failed the pass. The score, the passing score was 80%, was quite high, and we have just reached 69. I'm sorry for that, but there is no problem. We can still learn from it. See, we go in here to the review of the questions, and we see which questions did we fail. You see the correct answer. The correct answer is the last one. See, and here is an explanation. Okay, because remember the SAR is okay. The first refers to the stochastic. The second sentence makes reference to momentum indicators, and the third sentence corresponds to the parabolic indicator. Okay, so really the idea behind this indicator, as long as a trade is open, capital is at risk, and unless a trade can continue to generate profits over time, it should be liquidated. So for you to see that indicators themselves also started with an inventory, also started being an idea, and this may be the idea that leads the developer of the SAR to develop it. Because the observation was that unless a trade can continue to generate profits over time, it should be liquidated. So I need something that liquidates the position if it starts to print signals, if it starts to print to print a movement in against my profits. Okay. So as you see in technical analysis, the history of technical analysis, especially the more classical one, is very interesting in this sense, because we see that behind each indicator there is really a concept, an idea, and there was a need to come to the formula. And it's also very interesting to see how the indicators are built upon another, and everything starts really with an idea. And the truth is that everything that we see, that we can see in our world at some point was a concept, and this concept is drawn from the inventory. Okay, we are finished here. Let me just close the window, and if there are any questions, I don't know if I think we are a bit with time, short of time. The next speaker should be already waiting. I will give you the links. This is the news feed. Okay. This is the link to Richard Olsen's article, which I highly suggest. And well, especially the two units that from our learning center that cover the trading plan are the last two units, or better said, the last unit, and its chapters. I give you here the link. Okay, so you can go over it. Okay, ladies and gentlemen, I hope you liked it. This was my first webinar here at FX Street. Very happy for the large attendees list that we have today. Hope you enjoyed it, and sorry if there was any technical issue. Great, and see you in a couple of weeks. Thank you.